February 15th. What direction do you believe we're moving in? This lets me assess the community's position and identify the key insights you require. Allow me to explain this straightforwardly. Silver ended the day at 13,141 yen on the Shanghai Gold Exchange. That's a 4% jump in one session. Gold reached a fresh record peak of $5,344.70 on COMEX futures. Traditional finance outlets are beginning to pay attention at last. The Shanghai Futures Exchange reported silver rising 3% to 130 yen.95 cent. Gold climbed 3.58% to 5,316 yen.26 cents. Physical stockpiles on the SHFE saw 35.9 metric tons removed on Wednesday. Overall silver holdings now stand at only 58 metric tons. That's about 16,344,000 ounces. And this is the detail that jolted me awake at 3 a.m. when I spotted it. The SGE dramatically increased silver margins to 60%. Pause and absorb that for a moment. 60% margins on silver in Shanghai. As stockpiles plummet and values skyrocket. If you're unclear on the implications, keep reading, because this is the sort of action that reveals precisely what we've been talking about for ages. The tangible market is beginning to dominate the derivative pricing system, and those overseeing the real supplies are reacting in manners that disclose all you need to grasp about the underlying dynamics. Based on figures from the Shanghai Futures Exchange, silver stockpiles have undergone a steady depletion. We're discussing a total SHFE silver reserve that has fallen to merely 58 metric tons. For scale, that's around 16.3 million ounces. To give context, worldwide industrial silver usage for 2025 was projected at more than 580 million ounces by the Silver Institute. The current Shanghai holdings equate to roughly 2.8% of yearly industrial intake. 2.8%. And removals are speeding up. 35.9 metric tons extracted on Wednesday. That's not replenishment. That's not standard arbitrage adjustment. That's actual physical removal in a setting where surcharges are already high and the exchange is elevating margins to curb leveraged speculation. Now, let's link this to events on COMEX. Gold contracts achieved a new lifetime high overnight, $5,344.70. Conventional media is reporting it since it's an easy story. What they're overlooking is the foundational and systemic factors that led here. Gold has maintained a consistent upward path since late 2024, fueled by reserve bank purchases, especially from China, Russia, and various BRICS-associated countries. Ongoing worries about dollar erosion and international divisions. The gold chart pattern is classic. Rising minima, rising maxima, momentum aligning with price, trading activity backing advances. We're over the Ichimoku cloud across all significant periods. RSI staying above 50 during retreats. MACD in bullish crossover. This isn't a frenzy driven by bets. This is a fundamental revaluation of precious metals amid fading trust in paper money and reserve banks shifting holdings from dollar-based instruments. But this is where it becomes fascinating. Silver is surpassing the equity market in comparative returns. The graph of silver against the S&P 500, visible in shared data, displays silver in a clear escape from a years-long stabilization that began in 2011. We endured more than 10 years in a harsh, flat-to-falling pattern as industrial needs grew. Mine output leveled off, and derivative markets restrained silver via focused short bets. That proportion hit rock bottom and is now in a sharp rebound stage. Silver is beating stocks. However, and this is vital, silver remains far from its historical peaks. The raw high from April 2011 was near $49 on COMEX. Corrected for true inflation per approaches in books like When Money Dies by Adam Ferguson, or the currency erosion models in Jim Rickard's Currency Wars, that figure approaches $70 to $80 in present buying strength. We're at $113 to $115 on COMEX as of late January 2026. Shanghai lists it higher at 13,141 yen, but that's RMB per kilogram. Translate that and you still observe premiums over COMEX, but we're distant from inflation-adjusted records. That disparity is the chance and the strain. So why is Shanghai boosting margins to 60% at this moment? Let's reason it out. Margin levels serve as a risk control mechanism. Exchanges lift margins when they detect extreme swings, when they aim to temper betting activity, or when they're worried about supply strain. The SGE and SHFE differ from COMEX. they settle in physical form. When you claim delivery on the SHFE, you're extracting real metal from approved storage. The exchange has a strong stake in orderly trading and guaranteeing sufficient physical stock for fulfillment duties. When reserves dip to 58 metric tons, and you're witnessing ongoing extractions, 35.9 metric tons in one day, the exchange faces a risk where betting longs might outstrip available real supply. A 60% margin demand is severe. Typically, futures margins on platforms like COMEX or SHFE range from 5 to 15% based on fluctuations. 60% requires posting 60 cents of funds for each dollar of exposure value. That basically eliminates borrowing power. If you're a betting trader using leverage, you're compelled to exit trades or add much more security. The goal is obvious. The SGE seeks to dampen betting interest since the real market can't handle the derivative bets at existing reserve amounts. This isn't a flaw in the silver upward argument. This verifies that the real scarcity we've monitored is genuine. It's growing stronger, and the managers of real supplies are implementing urgent steps to avert a fulfillment emergency. Let's discuss what fuels that real scarcity. Worldwide solar array setups are forecasted to surpass 400 gigawatts of fresh capacity yearly until 2030, per the International Energy Agency. Each gigawatt of solar needs about 25 to 30 metric tons of silver in solar cells. That by itself is 10,000 to 12,000 metric tons annually. Over 320 million ounces solely from solar. Add electric vehicles, each needing 0.5 to 1 ounce of silver in wiring and power units. Global EV deliveries are set to reach 20 million in 2026. That's 10 to 20 million ounces there. Then consider 5G networks, AI server farms. Each large-scale data hub might demand thousands of ounces of silver in wiring and heat management, military uses, gadgets, and classic industrial applications. At the same time, global silver extraction from mines has stayed mostly steady to mildly dropping since 2015. Per the USGS, dedicated silver mining topped out and has found it hard to expand owing to falling ore quality, limited funding in the extended downturn, and that about 70% of silver comes as a side product from zinc, lead, copper, and gold operations. When those core metals aren't viable to extract, silver output shrinks. China leads as the top importer and user of silver. Per Silver Institute stats, China makes up about 1/3 of global industrial silver needs. They are also tactically placing in metals within their wider de-dollarization plan. We've observed Chinese curbs on exports of vital minerals like gallium, germanium, and rare earths. We've seen them amass reserves in copper, aluminum, and other key goods. Silver aligns perfectly with that strategy. It's a versatile metal, for industry and currency. If you're China and gearing up for a future where the dollar's influence wanes, where trade routes split by politics, and where tech rivalry with the West heats up, you stockpile silver. The reduction in SHFE reserves isn't haphazard. It matches planned extraction by groups aware of the enduring supply-demand mismatch. Now, let's shift to the broader economic scene. Gold at fresh records indicates a flaw in the trust framework of paper currency. Reserve banks worldwide have been net gold acquirers for 15 straight years. Per the World Gold Council, in 2024 alone, they added over 1,000 metric tons to stockpiles. That rate hasn't eased in 2025. Russia, China, India, Turkey, Poland. These aren't gamblers. These are national bodies spreading risks beyond dollar holdings. The idea that gold offers no return was once the automatic rejection from standard finance. But when actual rates, nominal minus real inflation, are negative or scarcely positive, and when devaluation threats rise from massive debt and ongoing printing, gold's lack of yield fades in importance. It's a value preserver in a realm where paper holdings are diluted. Silver trails gold, but with a difference. Silver shares the currency legacy. It served as money for millennia, but it also boasts industrial usage that gold misses. Gold is mostly unused in industry. Silver is expended. It's applied in ways hard to replace: conductivity, reflectivity, antimicrobial traits. That twin demand nature allows silver to exceed gold in a currency upheaval paired with industrial growth. And that's the exact scenario now. We're amid an energy shift needing huge silver volumes. We're in a tech contest: AI, quantum tech, cutting-edge chips that demand silver. We're in a political climate where countries stockpile key materials. And we're in a currency setting where reserve banks buy gold and buyers realize silver is underpriced against its basics. The chart view on silver backs this view. The silver to S&P ratio graph, silver and S&P 500 units, reveals a strong exit from a 13-year foundation. That foundation, built during a time silver was overlooked as industrial needs rose subtly, where derivative shorts on COMEX capped prices. The escape in late 2024 to early 2026 isn't a fake-out. Trading volume affirms it. The advance spans exchanges: COMEX, LBMA, SHFE, SGE. We're noting backwardation instances when spot tops futures, unusual for silver and signaling real scarcity. The COT data from the CFTC, monitoring COMEX bets, has displayed a gradual drop in the dense short holdings by a few bullion firms over the last 18 months. That short reduction lifts a long-term barrier that held silver down. When you mix lower derivative supply, reduced shorts with heightened real needs, and falling reserves, you achieve the price moves we observe. But to stay fair, there are factors that might pause or steady this surge. First, a 60% margin increase on the SGE aims to reduce betting drive. It will succeed briefly. Traders with leverage will need to trim holdings. That might cause gains realization and a retreat in Shanghai values that could spread to COMEX via trading links. Second, if world expansion slows, downturn concerns, lending tightening, industrial silver needs could ease short-term. Silver is more sensitive to economic shifts than gold due to its industrial uses. During a deflationary panic, silver may suffer more than gold. Third, central banks don't purchase silver like they do gold. Silver misses out on that institutional backing. If markets enter a widespread risk-averse phase, with stocks falling, bonds rising, and the dollar gaining, silver might decline along with other raw materials. Fourth, the U.S. Federal Reserve's approach is crucial. If the Fed shifts to tighter policy, if real interest rates climb, if the dollar surges notably, that weighs on all dollar-denominated commodities, silver included. And fifth, geopolitical tensions can swing either way. If conflicts subside, with trade agreements or diplomatic progress, the safe haven demand for metals could fade. These are genuine threats. This isn't a guaranteed win. Markets are never that simple. But here's the rebuttal, and this ties into the developments from the past day. The margin increase and the stock reduction in Shanghai aren't negative for the overall outlook. They indicate that the physical supply is strained. A margin boost is a reaction to overwhelming demand from the supply end. It's the exchange declaring, "We can't let open positions expand with these stock levels because delivery might fail." That's positive for those with physical silver. If you possess actual silver, you're gripping the resource the market is desperate to obtain. The futures market can influence prices briefly, but it can't create real metal. Industrial consumers, like solar firms, gadget producers, military suppliers, they require the tangible stuff. They'll bid higher. The gap between COMEX and Shanghai will expand if physical shortages continue, and that will eventually lift COMEX values. Gold hitting record peaks offers momentum. When gold surges, it reinforces the idea of a bull run in precious metals. Silver often trails gold early in these phases and then surges ahead as the trend develops and industrial needs add to monetary interest. We observed this in the 2000-2011 period. Gold dominated from 2001 to 2008. Silver began closing the gap in 2009, then exploded from late 2010 to April 2011, eventually surpassing gold in gains. The present scenario echoes that. Gold has led since 2022. Silver is now gaining ground. If past patterns hold, as Jesse Livermore's Memoirs of a Trader teach us, markets follow human behavior and cycles recur. We might be starting the stage where silver pulls ahead. The supply-demand basics are at their most favorable ever. The Silver Institute's latest study forecasts ongoing shortages through the decade's close. Mine output isn't rising. Even with elevated prices, new projects take years. Current operations face falling ore quality. Recycling aids somewhat, but silver recovery is poor. A lot of industrial silver is wasted or too costly to reclaim. The shortfall is authentic. It's expanding and covered by depleting surface stocks. The SHFE figures of 58 metric tons left mirror the worldwide trend. We're depleting reserves. Eventually, stocks vanish, and prices must climb to curb usage or spur huge new production. We're not there yet. Here's the key insight that changes the perspective. The 60% margin jump by the SGE isn't merely about curbing bets. It's about safeguarding physical stocks for vital national goals. Consider this. China is locked in tech and strategic rivalry with the West. They demand silver for homegrown sectors like solar, electric vehicles, 5G, military tech, chips. If betting funds, including foreign ones, inflate prices and drain Chinese reserves, that's a security issue. By raising margins to 60%, the SGE is basically stating, we'll make speculation too costly so the physical remains for our local industries. This is indirect economic rivalry. China employs trading rules to manage resource access, and if they're applying it to silver, expect it for copper, rare minerals, and other key inputs. This affects more than silver. It shows that seamless global commodity trading is breaking apart. We're shifting to a landscape where countries stockpile essential goods, where export limits spread, where prices vary greatly across regions due to blocked shipments. The spread between COMEX and Shanghai might grow hugely if China keeps limiting exports or adds silver bans. If so, Western purchasers, factories, funds, everyday buyers will vie for dwindling supplies, and COMEX rates will rise to match the rarity. Gold's climb to $5,344 isn't just a figure, it's a mental shift. It alerts the market that the two-decade flatline in real value is done. We're in a fresh era for currency metals. Silver at $131 in Shanghai, even after Forex adjustments, holds a markup over COMEX. That markup is a clue. It reveals where real demand lies. It shows that COMEX's paper value trails the actual situation. As awareness grows of this mismatch, as more factories seek stable sources, as more traders note silver beating the S&P 500 after years, money will flow in. We're at a turning point. The Shanghai margin spike could trigger brief pauses. It might eject timid players, but the core drivers, supply gaps, rising industrial use, global splits, currency weakening, central banks hoarding gold boosting silver, won't vanish. They're strengthening. The SGE's extreme action, 60% margins, highlights the severe physical crunch. And if it's this tight today, imagine when fresh industrial waves arrive? What if new crises spike haven buys into metals? What if COMEX hits delivery woes because transfers from London or Shanghai stall? The outcome is straightforward. Prices must escalate to limit demand, or output must soar, or both. Output won't jump soon. It can't. The facilities aren't there. The funding hasn't happened. So prices will adjust, and we're just beginning that adjustment. Silver remains 60% under its adjusted peak from history. Gold set new records nominally, but lags its 1980 inflation peak with true metrics. There's upside potential. And seeing bold exchange moves, stock drops, premiums, and contango flips, these signal the market revaluing from physical base to derivatives, and it's speeding up. Now, for owners and speculators, if you have physical silver, this affirms it. You're clutching what industries crave, what bettors are squeezed from, what markets are rushing to handle. Just hold and let prices align with facts. If you're dealing, swings will grow. A 60% Shanghai margin could spark near-term sales as geared trades unwind. That might dip COMEX. But if dips stay over main supports, like $31 on COMEX, the 50-day average, they're entry points. The direction is upward. Basics are positive. Charts agree. Global context helps. Economy suits it. If considering a position, study up. Know it's volatile. Realize short swings can be steep. See it's not quick riches. It's a years-long revaluation of an overlooked, limited supply, key industrial money-linked metal. Brace for ups and downs. Trust the argument. Plan exposure for your risk level. Think long-term, not short. The wider message is markets are splitting. The post-war setup of open commodity flows, clear pricing, efficient arbitrage, that's fading. We're in a divided world where states fight for inputs, chains localize, prices split as goods are blocked. Grasp that change, align with it, own scarce vital physicals, and you'll gain. Stick to paper expecting old ways, and you'll risk loss. 3 key points from this update. 1. The 60% margin leap by the SGE signals intense physical silver strain, with exchanges using urgent steps to handle it. 2. Gold's new peaks confirm the precious metals uptrend and boost silver, which shows initial edges over stocks. 3. SHFE stocks at 58 metric tons, with faster pulls, verify the ongoing supply gap we've followed, and that gap will push prices up eventually. The open question: how far must prices climb to cut demand or add supply? And how soon before COMEX sees global spread of Shanghai's crunch? Research yourself. Check these facts. Know the dangers. This isn't guidance. It's review of a fast-changing scene where physical and futures diverge, and results in the coming 6 to 12 months could reshape precious metals views for years.